All right. Very good. Well, thank you so much for having me on. I'm excited to be a part of this event, not just a presentation, but multi-speaker event that is always super exciting. Always so many great traders that are invited on here. And, it's a gift, really. It's a gift and it's an honor to be among these other great traders. You know what? My chair just went down. I'm going to raise my chair a bit. All right. It's kind of funny. It was like in a high chair, and I felt like I was a child that was slowly going down, 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 down. All right. Now I feel like a big boy again. All right, everybody. Well, I'm Dr. Barry Burns, and I own Top Dog Trading. So today, I'm going to share with you my Fibonacci trading webinar that I put together for you. And at the end, you get a free mini course that I'll give everybody here. So absolutely no cost, just my gift to you. And I'm here in service to the trading community. All right, let's see. Just looking at the chat box here real quick. Okay, not seeing any questions yet or anything like that. So since we have multiple speakers, I know you've probably seen this before, but some of you may have not seen it. Some of you may have just come in. So we have to use our disclaimer slide here. Very, very important. I never joke about this. I'm not going to read through all of the words. I'm sure you don't want me to, but please do read it. It's very, very important. And think of it this way. The regulators are, they're really trying to protect you. You know, most traders lose money. And what's interesting is that most of the reasons traders lose money are actually addressed in these regulatory statements. It's pretty fascinating. And I totally understand it's not very entertaining or exciting to read these, but they are very, very important. And they're not only, it's not just legalese, it's your education. And some of the stuff is not maybe what you want to hear, but it's what you need to hear for purposes of not losing your entire trading account, not blowing up trading accounts, things like that. So please take time to read this. And it's on all the websites and everything as well. So very, very important. All right, so there's my ugly mug. I'm Dr. Barry Burns. I'm the owner and founder of Top Dog Trading. And today I'm giving a very serious presentation. You can tell because I've got my glasses on, so you know it's serious. I'm a professional trader as well as trading educator. Got over 50 years of experience under my belt. I was actually trained initially by my father. My dad was a stock trader as well. And he started me out when I was 8 years old. So been trading for a long time because I'm unyoung. And when I got really serious, I decided to make a career out of this. Then I went to Chicago, got trained by a floor trader there at the CME. And since then, I've conducted seminars internationally all over the place. And when he went back and gave a presentation for the Chicago Mercantile Exchange, the York Exchange, etc., I'm a real published author, Wiley & Sons, one of the most famous publishing firms in the world. And of course, the Dummy series of books, very famous series of books. They literally came and asked me to write this book. I did not seek them out. I didn't even want to write a book. It's a lot of work and it does not pay money. Very, very little. My commissions every year when I get my tax statement, it's like, wow, really? That's it? So you definitely don't write books for money. But one of my mentors, he always told me, he said, Barry, you better write a book. You've got to write a book. You've got to write a book. And he never got to see me write the book before he passed away, unfortunately. Great man. His name was Ray. And I kind of did it in his honor, as well as, again, I just wanted to give back to the trading community. So Trend Trading for Dummies, feel free to pick it up, Amazon or wherever better trading books are sold. And I've also received many, many, many Reader's Choice Awards, actually every year for, I can't even remember how many years, from this great magazine, Technical Analysis of Stocks and Commodities magazine. And what I love about receiving these awards is that the awards are granted by the readers. And they've got, I think it's 1.2 million readers worldwide. So it's not some committee or, it's real traders, people just like you who are voting on these awards. By the way, if you voted for me, thank you very much. Really appreciate it. Got a podcast. Feel free to, wherever you listen to your podcast, just type in Top Dog Trading in the search bar. You'll see my podcast there, obviously for free. I've got a big YouTube channel. This is an old version of it. We've got about 120,000 subscribers now and hundreds of videos. Again, all for free. I give away a lot of free education. And don't want to talk about myself anymore, so I'm going to skip through this slide here. These are just other companies that I've worked with and continue to work with, stuff like that. Okay, now let's talk about the good old Fibonacci. So the first slide here, I just want to give you an idea, a concept of how Fibonacci is used in trading. And then we're going to go through some details. And we're going to start with the basics. And if you already know the basics, I'm going to give you some advanced techniques today too. So we got something for everybody. Beginners, intermediate, and advanced. And then finally, before the end of the hour, I'm going to put it all together into a system, a trading system, a methodology that you can follow. All right. So, but just to, because we have people with all different, actually, let me ask, if you would type in to the chat box how long you've been trading. Just put it in your own words. I just want to get an idea of, am I addressing beginners, intermediate, advanced? Because I can, like, obviously I've got pre-rendered slides, but I can modify my presentation if I know Roger, 20 years. Wow, that's impressive. All right, so definitely not a beginner. 20 years, 2 decades. Congratulations. That's fantastic. Anybody else? Don't be so quiet. Don't be so shy. As a trader, you can't be shy. Got to be up there and you got to be, I don't like to use the word aggressive with trading, but assertive is a good word. Let's see, where's my annotation bar? There it is. Okay. So, Conrad, I'm a born again trader learning from my mistakes. I think there's a lot of those, Conrad. I think there's a lot of those. The D-Mount 1, is that the name on your birth certificate? 3, Brian, 5 years, but recently increased my frequency. Excellent. Matt, too long knowing nothing. Oh, that is, again, such a common experience. And anyway, maybe we'll talk a little bit about some of that because, again, most people do lose money trading. So what I want to point out here today on this first slide is why we're even talking about Fibonacci. So this is the Fibonacci sequence up here, but the way we're going to use it in trading, okay, set the stage for how we use it, is that we look for an impulse move like this going down. So we've got a downtrend from this high to this low down here. And then the question is, all right, if that trend's going to continue, where is it going to retrace to? How far will it retrace before the downtrend will continue? And so we draw these levels, and this is a drawing tool, usually under the drawing tool section of your charting platform. And so this one is called Fibonacci retracements because you draw it from the high to the low of the trend. And once it bounces off of that, it'll draw these percentage retraces. This is going to retrace 23% or 23 per, I'm going to round them off. 23% back to the high, 38% back to the high, 50% back to the high, 61%, 76%, or all the way back, 100% all the way back to the high. And that's what these percentages mean. And they're pretty reliable. They're pretty darn good. All right, so now, how are Fibonacci numbers discovered? Let's get to the little, the core of the issue. So the sequence of numbers named after Leonardo Pisa, who was also known as Fibonacci, that simply means son of Boccaccio. He introduced the sequence to the West in 1202. However, the sequence had actually been used in India long before that. So we call it the Fibonacci sequence or the Fibonacci tools, but it's usually the Westerners who get the credit, even though a lot of these kind of things were discovered in the East before that. So what are Fibonacci numbers? In reality, at their core, it's a mathematical sequence of numbers that begins with 0 and 1, and then each subsequent number is the sum of the previous two. All right, so this is called, again, the Fibonacci sequence. And this is the basis for retracements, extensions, everything else we're going to talk about. So again, you start with 0 and 1, and 0 plus 1 equals 1. Right? Then what do we do? But then we take 1 and 1, and we add them together, and it equals 2. Then we take 1 and 2, we add them together, and we get 3. Then we get 2 and 3, add those together, and you get 5. So the sequence starts out 1, 2, 3, pretty simple, but then it jumps to 5. 4 is not a number in the Fibonacci sequence because it doesn't fit this mathematical model. Then the number jumps to 8 in the sequence. And again, you'll see it up here, 1, 2, 3, 5, 8, 13, 21, and so on. All right. So that's the sequence. Now, why are they considered significant? They're considered significant. This goes even way before trading. They were mathematically considered significant for several different reasons. They're found in the structure of multitudes of natural patterns. In other ways, they are an organizing principle of nature. So we see it in different types of flowers. The most famous example usually used is the nautilus shell. But geometrically, when you look at all these patterns, mathematically, they are based on the Fibonacci sequence. Now, in trading, sometimes people do use the Fibonacci sequence. W.D. Gann was very famous for doing that. Today, I don't often see people using that too much anymore, except sometimes people will use a time interval that is a number in the Fibonacci sequence. So I will see people using 144 tick charts or 610 tick charts, things like that. But mostly in trading, people are using the ratios. Now, each number in the sequence is approximately 1.618 times greater than the preceding number. So this is the most important, most famous of the ratios. It's called the golden ratio or the golden mean. And there's some traders that use just that. I know one person very personally, very specifically, who this is his whole trading is all about just that, the 1.618. And that's all he trades. And he does very well. Now, the other two key ratios that are determined by dividing any number in a series by the number 2 places to the right, and then the number 3 places to the right. So just to spell it out, here's our Fibonacci sequence. 6 to 1.8 ratios found by dividing any number of the sequence found 1 place to the right. So we'll start here with 13. Take the number 1 place to the right. Okay. 13 divided by 21.619. Now, it's not going to always be exactly 618, but it's in the ballpark, good enough for government work. And then the same thing. If we go to the next number and 21 divided by 34, okay, again, you get the Fibonacci ratio. 34 divided by 55, again, you get the Fibonacci ratio. So that is the significance of this most important ratio, the golden ratio, and that's how it's found. It's just mathematicians discovered this, and they're always experimenting with numbers, and they're like, wow, that's very interesting. But they had to come up with a sequence first, and then they started noticing that this ratio is very consistent. Now, there are other ratios that we use in trading, 38.2. That is found by dividing any number in the sequence that is found 2 places to the right of it. So I'm not going to spend as much time on this. I think you're getting the pattern. So we start with 13. We go 2 places to the right of it, divided by 34. And there's your 38. 21 divided by 55. There's your 38. 34 divided by 89, right? 34, 89, 38. And that's consistent throughout the whole sequence if we did it until the planet moved back and exploded into the sun. And then 23.6 ratio is found by dividing any number 3 places to the right of it. So again, I'll just show you one example here. Again, we start with 13. So if we go 1, 2, 3, divided by that number, and then we get 0.236. All right. So now that we've established just the mathematics of it, 38 and 23 are secondary Fibonacci ratios. Now, where do 50% and 76.4% come from? Well, 50% actually is not a Fibonacci ratio. It's simply been observed that it's a common support resistance level. And again, W.D. Gann used 50% very heavily. In fact, there's a whole book written on just that. And again, I know a trader who does nothing but just trade the 50% geometric patterns. And he does very well. All right. Now, 76.4 technically is not a Fibonacci ratio either, but it's just the mirror of 23.6. In other words, 100 minus 23.6 is your 76.4. Now, some traders, instead of 76.4, they'll use 78.6. And their reasoning is that that's the square root of the golden ratio. I've tested both, and it doesn't make a huge amount of difference. But for me, and for my money, I prefer the 76.4. I've found that just watching price action over 50 years, it comes into that 76.4 more often than it reaches the 78.6, which kind of stands to reason just because it's closer. Okay, so I'm not saying there's any magical, Eastern, I don't know, Orthodox, astrological, I can't even think of any words now, Babylonian esoteric secrets to this. All right, but these are things that are just really mathematical and that work. Now, people use other things for, and this is kind of called market numerology. So Gartley patterns, astrology, squares, those are all very cool too. Those are all very cool. But in this webinar, because we only have so much time, 45 minutes left, actually 44 minutes left, we're going to keep things simple. And today we're only going to talk about these ratios that I've already shared with you and their extensions. So we looked at this already, Fibonacci retracement. And the purpose of the Fibonacci retracement is to say, all right, once we get from this high to this low, how far do we expect it to retrace? And as you can see, these levels, once they're automatically drawn in, it slices, after it gets down to the bottom, it slices through the 23.6 leg bottom, like it's not even there. So don't think that the market's going to respond to every single one of these levels every single time. It's not. And we're going to talk about that. We're going to talk about how to determine which ones will hold. So this time it goes all the way back up to 50%. But then when it comes back down, it does find support at the 23.6. Then it goes up to the golden ratio, the 61.8, and then comes back down to the 23.6, goes back up to the 61.8. So even just not necessarily functioning as a continuation of the trend, these do still provide support resistance levels. And that's really the best way to think of what these Fibonacci levels are, is they fit into the broader category of support resistance levels. Here's another example, Fibonacci retracement. Boom, we drop from there to there, and it goes, we drew it from there to there. Okay, so that's from this low to that high, and it retraces down to the 618 golden ratio. All right, so now let's talk about Fibonacci extensions. Fibonacci extensions have a different purpose, and not as many people use Fibonacci extensions. It's a different drawing tool in your trading platform, but it should be in the same area as the Fibonacci retracements. So Fibonacci extension is a 3-point drawing tool. You have to mark 3 points on your chart. So we start out doing the same thing we did with retracements, from a high to a low, but then you click one more high. And then what it does is it adds. Now see, the numbers come over here. They're not over here. They're not measuring a retracement from that high to that low. No, what they're measuring is an extension from this high downward. So whereas generally I use Fibonacci retracements to look for where to enter a trend continuation trade for entries, extensions I use for exits, just the opposite. So obviously you can use these two tools together, one for entries, one for exits. And so profit targets would be another way of saying it. So now if we get in here, we're looking for, all right, where are some profit targets that are below this low? Because that low, sure, we could see that's probably going to be a support level. But once it gets below there, oh, now we're in price discovery. Where's the next resist or the support level in this case? Well, as it turns out, it's the 76.4 extension. And that level would be invisible if we didn't use Fibonacci extensions. Then it goes back up again. Look at that. Goes to 38.2. It's just amazing how it will bounce off of these levels. And then it goes all the way down to the 100% extension. And then it bounces back up to 23.6, back down to 76.4, and then we get a big green bar. Okay, now this movement of 100% on a Fibonacci extension, it has a specific name. It's called a measured move. And again, there's people I know who trade only measured moves, and that's what they're doing. They're doing this tool, using this tool, and then they're looking to capture wherever 100% comes in, that's where they're looking to get out. So it's a good tool, but I don't use any of these tools in isolation. I use them together as part of other things. Now, as I said, you can use Fibonacci extensions and Fibonacci retracements together, and actually, I think you should. So that's what we do here, and we create Fibonacci clusters. So the Fibonacci retracement was drawn from that low to that high. And that gives us these levels here. Then the Fibonacci extension, remember it's a 3-point drawing tool. 1 starts at the same place, 2, and then 3, and then it creates these numbers over here. And now what we're going to look at is where do we have levels coming in together from the retracements and the extensions, and it creates a cluster. So so once we come down to here, it's a double support level. Once we get up into here, okay, we got the 100% measured move, and we've got the 23.6, and we see, oh, the market just kind of consolidates there. It found resistance. So support here, resistance there as a cluster. All right, time to go to the more advanced stuff. Let's see. Okay, I'm not seeing any questions or comments there in the chat box, which is fine. But if you have some, feel free to type them in. Now, a lot of people don't know. I'm going to get a little swig of some vitamin water here. Hope you don't mind. All right, now I'm re-energized. This is a tool that very, 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 very few people use. So this is advanced. It's also a concept that a bigger concept that most traders don't use. And that is incorporating time into your charts. Absolutely critical in my never to be humble opinion. You know, a chart is a two-dimensional object. We have price on the right, and we've been talking about price levels, support, resistance. And everybody in their parakeet talks about that. That's your y-axis, and that's fine. But if you're only trading price levels, you're missing out on 50% of the information on the two-dimensional chart, because the other dimension is time down here. So how can you be profitable? And well, let me put it this way. How can you have a probability scenario if you are leaving out 50% of the information on a two-dimensional chart? I think it's really hard. And again, I will refer back to W.D. Gann. W.D. Gann, one of his main concepts, which I love, is he would always be looking for the confluence of time and price. And I don't hear many people talking about that anymore. I just hear people talking about price levels. And again, that's why I don't just use them. So Fibonacci time extensions. Now what these are is, again, we're going to start from a low, and go to a high here. Okay, now you'll see the line is down here, but the horizontal line goes up there. That's just because I didn't want to cover the bars with this slide here. Okay, but the dots show that I drew it from that low really to that high. Now, again, these are extensions. So that means it's going forward. Retracements measure back. Extensions measure forward in time. So again, these are going to be price targets, but they could also be entries because I can't draw this until this high is put in. So actually now I'm going to be using these time extensions to look for both entries and exits. What time do I get in? What date? It depends. So if you're swing trading, these are, oh no, this is a 5-minute chart. So, okay, what time should I get in? You can use it on 5-minute charts. You can use it on daily charts, weekly charts, monthly charts, whatever. But the whole issue is time. So here we see, oh, it created a vertical line here. So we should be looking for a shift at this time, a price shift. Boom, sure enough. And again, here at the, well, look at the numbers, 123. Now, whenever you see the number 123 or 138, in other words, a 1 before the 23, 38, 50, that means it's an extension because it's past the 100%. And now, also note that it doesn't nail it right on the line. So don't expect that. These lines, consider them more like zones. And that's also true of horizontal support resistance, by the way. Don't consider them lines, even though we draw them as lines. In the way the markets move, the price action, the bid ask, people placing the orders from all over the world, different internet speeds, people trading different systems, people trading different time intervals. There's a messiness to the market. So you can't expect that everybody is watching your market on your time frame and that it's going to hit it right to the bar. So this is, again, where we're going to need, some other things to make precise entries, but this is the time when we're going to start looking for an entry. This is the time we're going to start looking for an entry. And then this is the time we're going to start looking for an exit. So very, very important. Muy importante. Now, let's put it together. So as I said, W.D. Gann talked about the confluence of time and price. There's several tools that can be used for that. This is definitely not the only one, but this is one. Again, we only have time to talk about so much today. So this tool is called Fibonacci circles, or your software might call it Fibonacci arcs. They're both the same thing, just two different terms for the same thing. Now, what this does is really cool because it measures both time and price in one drawing tool. So again, we always start with drawing from a major high to a major low, or from a major low to a major high. Okay, so boom, we draw it from there to there. And then what it does is it creates these, see how it's curved? Instead of having horizontal or vertical straight lines, now we've got these curved lines. And that's why they're called arcs. But again, some software calls them circles because actually if we what do you call it, pulled out enough on the scaling, you would see that it actually does create a complete circle. It actually does. But usually all that's visible on your chart and whatever scale you're using is the arc. So either term is appropriate. So what we look for is, all right, as it goes up, 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 and now this line is going to curve, and we see it riding the line, and then boom, giving away. So obviously you can either do this as an entry or as, if you got down here, if you got in down here for some reason, then you'd use this as an exit. If you wanted to, by the way, there's also resistance here. If you saw that and you said, oh, okay, got that. And we got a red bar, boom, I'm going to short this puppy. Okay, and then the puppy is shorted. Okay, by the way, no puppies were harmed in the delivering of this webinar. All right, sorry, just had to throw a little dad joke in there because I do have 2 daughters and it's my political responsibility here in Los Angeles, California, that we are required to do at least 2 dad jokes every hour. Otherwise, Gavin Newsom comes and gets us and exports us. Okay, that was my 2 right there. Now, I also want to point out something. Notice how we put in a major low here, but there's no Fibonacci arc or circle there. So I love showing this because I don't want you to expect that every major swing high and every major swing low is going to be identified by this tool, or frankly, by any of these tools. That is not there's no tool that catches every major swing high or every major swing low. So just put that out of your mind. It's unrealistic to expect that. Don't be disappointed. Don't think, oh, the tool didn't work because it didn't catch that low. And then you're trying to readjust the tool and all that kind of stuff. That will lead to an endless frustration. No, you just use it. And when it does give you a signal, and it's a good signal, then you take it. And the other ones, you just let them go. Okay, I didn't get a signal there. The markets do all kinds of stuff. They go up, they go down, they're noisy. There's catalyst, there's rumor, there's gossip that make them go up and down. So we're not going to catch every move. And that's okay. We just use, and again here, boom, goes up. And then as it comes into the next arc, it goes down. All right. So now I promised you that I would take this and put it all into a system. And that's what we're going to do now with our last half hour. So we've talked about the Fibonacci. And as I said, I do not use this in isolation. My system is called the Top Dog Trading 5 Energy Methodology. And what I'm doing is I'm literally measuring the energy of money flow in the market. They say actions speak louder than words. And the money flow, the supply demand, that's the action of the market participants. People get on TV, financial news, all this kind of stuff, and they talk blah, 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 blah. And then they got to talk because they got to, and they also sound so dramatic and, oh my gosh, it's incredible. Oh my gosh, it's horrible. And they've got to do that because they got to keep your attention and they get to get you emotional and riled up so you go back and watch the show and they can sell ads. I don't listen to any of that. I just don't, because I don't want to be swayed by it. Again, actions speak louder than words. I don't want to hear the words. I don't want to hear people's opinions, even the real educated people who are very intelligent. I don't even know. I want to know what they think. All I'm going to do is follow the money, honey. That's it. That's what works in trading. That's the actions that speak louder than words. And so the energy of money flowing through the market is all that I follow. Now, I measure 5 different energies. So the first one is trend, and we'll use a moving average for that. The second energy then is momentum. And of course, you use a momentum indicator for that, real complicated stuff here. The third is cycles. Now, this is the timing part of my methodology. This is the x-axis part. It tells me when to get in. So the y-axis, you could think of that as where to get in. And then the x-axis down here, confluence of time and price, you can think of that as when. Okay, when and where. So, and then I have a cycle indicator for that. Support resistance. Now, there's many different types of support resistance, previous swing highs and lows. I pointed that out briefly in passing, but Fibonacci, that at least the first couple things we showed in Fibonacci, that is support resistance. So it comes in as the energy number 4 in my trading methodology. And then the 5th energy is I call it the fractal energy, which is just a fancy name for using a higher time frame to confirm the setup on the shorter time frame. So I'm using the shorter time frame as my setup chart. That's where I look for my trading setups. And then I confirm with the fractal energy. And I'm doing this to establish a probability scenario. That's what trading is all about. Okay, it's not about finding certainties. Nobody knows what the market's going to do. There are no certainties in trading. And, whenever anybody asks me, how do I know if, or how do I know when, or how do I know anything? Right away, I have to try to give them a teaching moment and say, okay, let's remove the word KNOW, no, from your vocabulary and even your self-talk, because we never know. We're only establishing a probability scenario over a large sample of data. So how do we do that? Here's how I do it. At each entry point or each potential entry point, I ask myself how many of those 5 energies are aligned, being bullish or bearish. Based on that, I give it a score of 1 to 5. The higher the score, the higher the probability of the trade. And what I'm doing here is I like to say I'm taking each trade to court. And so I say that because I need 5 independent witnesses to establish a preponderance of the evidence. So you can't just, let's not oversimplify this. You can't just put any 5 indicators on a chart and say, oh, I've created my own 5 energy methodology. No, the core of it, really the crux of it, is that these 5 energies are all, or each one is uncorrelated to the other 4. So if you were to put 5 trend indicators on your chart, that'd be redundant and ridiculous and useless. So these 5 energies were chosen because they're uncorrelated to the other 4. So when they all align, then we have a probability scenario. All right. So let's take a look at each one of these and show you a little bit of the details here. So again, I'm not using any proprietary indicators. So you don't have to buy any indicators from me. Energy number 1 is trend. We always start with trend. And by the way, we look at these energies in this order. It's a very linear system. We look at trend first because the first thing in trading is very binary. Do I want to go long or short? Or is there no trend? If there's no trend, then I don't want to trade because I'll just get my trading account chopped up. So simple thing that I use, 50-period simple moving average. Okay, it's an intermediate trend indicator, gives the overall direction of the market. That's my red line there. Okay, it's not the short-term direction of the market. Trend, by the way, does not refer to a short-term move. It always refers to a longer-term move. All right. So many people say that trend is defined by higher highs and higher lows, but that's not really a good definition. In fact, literally, Webster's dictionary definition of the trend is to extend in a general direction. That's what a trend is, to extend in a general direction, just to overemphasize. Now, I'm not saying that just because I want to be, accurate with the dictionary, but there is a very, very important trading benefit to understanding that that's what a trend is. So for example, here, we have lower high, lower low. This is not a downtrend. This is simply just a complex retrace in a longer term uptrend. So the trading reason to define trend as the extended general direction is because a trend trading system is designed to have a low risk and a big reward. So the direction we're trading is a long-term direction, and we're relying on that for a big reward, a big follow-through, not little moves like that. All right, let's go to energy number 2. Momentum. I love momentum. It's one of my, I like them all, but again, I don't rely on any one of them. In fact, let me say this. Any one of these energies and any one of these corresponding indicators and a $20 bill will get you a homeopathic amount of caffeine at Starbucks. That's how much it's worth. They're worth nothing. Okay. No one indicator makes you money. In fact, if they did, we call them money makers, but we don't. We call them indicators. And the reason we call them indicators is because that's exactly what they do. They indicate. They don't tell, and they don't make money. So they're, again, back to the kind of court case example. They're pieces of evidence that we put together. All right, so energy number 2, momentum. Now, we've got our trend indicator here, the 50 simple MA. I'm not going to trade with just that alone. There are two types of trends. And when I ask people, and I'm not going to do it here, but when I ask groups of people, what are two types of trends? Inevitably, the most common answer I get is uptrend and downtrend. While that is not a wrong answer, it's a right answer, but it is not the answer that professionals would give you, because uptrend or downtrend is too obvious. The thing that most people don't know, and by the way, here I'm going to introduce my little slogan, the dollars are in the details. So the dollars that are in the details with regard to two types of trends is strong trend and weak trend. And each of those can be either up or down. Okay, that's just an obvious thing. The not obvious thing that people losing money don't know is they're trading weak trends. And weak trends don't follow through, and they're not even aware of the concept, and so they lose money. Strong trends follow through. Well, how do we know if it's a weak trend or a strong trend? That's where momentum comes in. So here's my momentum indicator down here. So we've got higher highs, higher lows, higher highs. Okay, now watch this. So the momentum indicator says, yep, that's a strong trend here. Awesome. Okay, comes back down, retraces, goes back up. Oh, still a pretty strong trend, but it's an equal high on momentum. And then we get a higher high on price, and we get a higher low. But what happened on the momentum indicator? Uh-oh, lower low on momentum versus a higher low on price. Lower high on momentum versus a higher high on price. So that means at this point now, this trend is not supported by momentum, and the strong trend has turned into a weak trend, and therefore we're going to get out. Actually, you have two choices. You can either, if you've been in the trend, that's where we would get out. That's how we know when to exit. When a strong trend turns into a weak trend, boop, pull your money back out. Or maybe do a trend reversal trade if you like to do trend reversal trades. Those are not as reliable, by the way. So that's the key difference there. Strong trend, weak trend. Now, momentum could even be a leading indicator of trend and even a price. So here's an example where we have a little higher, basically, market's not trending up a lot. It's just kind of chopping. But we got a little higher high on price and a lower high on momentum. And then, sure enough, boom, then the trend, a nice trend starts down. And then it's a strong trend too, right? Because boom, momentum makes a lower low, lower high, lower low, just as price does. So we can, the point on this one is not only can you trade it in trends, but you can trade it to find breakouts out of consolidation. Look for times when momentum is just kind of price going sideways, chopping, momentum kind of chopping, and then look for the momentum shift is what we call it, to trade breakouts out of consolidation. All right, energy number 3, cycles. Got to keep going here because otherwise no, I'm okay with time. So this comes into the topic I was talking about before, timing. When to get into your trade. So I've got an indicator for this, which I'll give you this for free. It's actually a common indicator. It's not something I made up. I modified it. So when I say give it to you free, I'm just going to show you how I modified it, and you can use it. So I'm not selling you any indicators here today, as I already said. But the key is cycles are the rhythm of the market. They give you an indication of when to buy and sell. So remember, support resistance, where to buy and sell. Okay, so I was talking about the 5 energy methodology. I'm not going to review because I want to respect everybody's time here. But maybe I'll go back just real quickly if I can. Let's see. Yeah. So energy number 1 was trend, direction of the market, the overall long-term direction of the market. Energy number 2 was momentum, the strength of the trend. Okay, and then now we talk about cycles, when to enter the market. And as the previous speaker was saying 100% true. All of this has to be rule-based, right? I really appreciated what he had to say. This is not about guessing, and indicators do just indicate. There is no such thing as a leading indicator. So I really do affirm what he was saying. I really appreciated that. So we're putting together, and this is all a rule-based, objective rule-based methodology using 5 uncorrelated indications of the market. And then when we put them all together and they're all bullish or bearish, then we have a high probability of a successful trade. Still not a certainty, never a certainty, but a probability. And so now we go to cycles. Cycles are the rhythm of the market, the timing. So they tell us when to get in. So here's the cycle indicator. And again, you'll get access to this if you download my free stuff. And for full disclosure, it's not a proprietary indicator. It's a common indicator, but I've modified it a bit. I give you all that information in there. And so it just tells you, okay, when. So at a cycle high, okay, we want to go short, cycle high, cycle high, cycle high. Now, we want to go do it with the trend, right? We don't want to trade cycle lows against the trend. We want to trade cycle highs with the trend. All right, and so again, cycles indicate timing, but they don't indicate range. Very, very important. That's why these 5 energies are different. They're uncorrelated. Otherwise, we wouldn't need to, be redundant. So like a cycle, don't think just because you've got a cycle low or a cycle high, the market's going to move a lot. No, it's just about timing. So the direction has to do with trend, and then the range, how far a market's going to move, the energy of momentum is what determines that. And then cycles is just when. So you're going to see a lot of cycles that don't move very far. And that's why we can't trade just cycles by themselves. Very important to understand that. Energy number 4 then is support resistance. And that's what I started talking about the first half of my presentation with Fibonacci. And so we use Fibonacci. I use previous swing highs and lows. If I'm day trading, I use floor trader pivots. So there's different types of support resistance you can use. So today, obviously, we talked about Fibonacci, and that's the levels, the price levels. Okay, that's where the y-axis comes in, the where, and then the cycles is the when. And then the fractal energy is the fancy term for the next higher time frame. So what I'm looking for here is, there we go. So here's my 2-minute chart on the left and a 6-minute chart on the right. So I'm using the shorter term chart as my setup. So what I've got here is a new trend, 50 MA, starting to move down. This black line, by the way, is the 15 EMA. And I use that because we want to trade early in the dominant energy of the market. So dominant energy, trend being down. Notice our momentum indicator down here is below 0 and down. So that indicates strength down. So I've got a strong downtrend. We're early in the new trend. That's another thing. We want to only enter trends early in new trends, because we've all heard the trend is your friend until the end. And the meaning behind that, the explanation behind that is the longer trend continues, the less probable it is to continue. So again, probabilities. So I like to only take the first and second retrace in the trend, or first or second cycle high in a new trend. So this is a new trend, and we've got strength down. Now, it holds the 15 EMA on its retrace. So that means, again, we have price action indication of strength down, weakness up. I don't want it to violate above the 15 EMA in a downtrend. And that's the only reason I'm using the 15 EMA there, is to indicate a weak retrace, not a lot of buying coming in. So the reason it's retracing is probably either just some profit taking, or maybe some amateur buying against the trend, which they commonly do. And so we wait for our cycle indicator to turn back down, and boom, we take the trade down. The fractal energy, we look to the next higher time frame. I like to use a 1-to-3 ratio in my time frames. And the only thing I'm interested in on the longer term time frame is, again, momentum. I'm not as interested in trend on the longer term time frame, because trend, again, remember, it's extended general direction. It's a very lagging indicator, actually. very slow. So trend on a 3 times longer term chart is really slow. It's not going to give you that precision for your entries. In addition, momentum is strength. So look, we want strength down on the short term and strength down on the long term. So when we have both of those, momentum, bearish momentum on the short term and the longer term chart, now we've got a markets that very likely to haul patootie. All right, as the kids like to say these days. So, so that's it. And what you're really doing with multiple time frames, what you're kind of tapping into a larger group of traders, and you might say, well, that's just a self-fulfilling prophecy. But what else do you think trading is? It's what the masses are doing and the money piling in, and the more money behind it, supply, demand. That's the bottom line of the bottom line. And what all we're doing is different ways of measuring supply and demand imbalance. All right. So this 5 energy method is very robust and adaptable. You can use this for pretty much any market or any time frame. Only qualification I would say is you want to make sure the market you're trading is good liquidity, good volume. Volume is very important. So I trade it for stocks, commodities, options, currencies, futures. I even use it with cryptocurrencies now, investing, swing trading, and day trading. So again, it's just a matter of which time intervals you're using on your charts. But with the indicators and everything, it automatically adjusts to the relative time frame that you're using. So you don't have to change parameters or anything like that. And it's simple. And it is objective. We're not trading from emotion or feeling or gut feel or what you think or what your opinion is or what the guy on CNBC said or Bloomberg or Financial News Network, whatever. No, we're just objectively scoring 5 uncorrelated energies. So I provide a complete trading plan. Also, I get into the psychology of trading. If you ever decide you do want to buy a course from me, my course always comes with a complete trading plan, which is money management, risk management, all the rules spelled out in a linear, like check. It's literally a check off. It's a list of check boxes is what it is. So it's that rule based. I include a course in psychology of trading. I don't believe in people buying a course without also improving their psychology. All mastery is ultimately self-mastery. And there's a lot of people who know a lot about trading, know a lot about technical analysis, and lose a lot of money. Quite often, it comes down to here. It's not in the chart. It's not that they don't know stuff. It's not about knowledge anymore at this point. It's about their self-control, their emotions. They're managing themselves. Okay, you can't manage the market. The market is like a wild animal. It cannot be domesticated. So the only thing you can control is yourself. And so we teach people about that. I won't sell a course without teaching people about the psychology of trading. And then a scorecard, like I said, just 1, 2, 3, 4, 5. So this is the freebie that I mentioned. You can just go to rubberbandtrade.com, and that's where you can get my rubber band trade for free. And it's a complete trade setup. I still trade it to this day. This is not some old, trade, a has-been trade that I no longer use. And so I'm like, I'll just give it away. No, I still trade this. I scan for this trade every single market day. And every day it sets up, I take this trade. That's how good it is. It's current. And I'll give you all the rules to it. It's a reversion of the mean mathematical model, by the way. Again, everything we do is based on statistics and mathematics. And then also, the course that it's in, the rubber band trade, it's in this little mini course that I call Make Money by Breaking Every Trading Rule You Ever Learned. There's 5 20-minute video tutorials in it. So it's not real long, pretty short. And you'll get interactive quizzes so that you can double check to make sure you're understanding everything. And then also there's I'll give you access to a webinar recording. This is a webinar I did a little while back, and that's where you get the cycle indicator. Okay, and again, just giving that to you for free. It's a traditional indicator that we've modified. I show you how to modify it, but then more importantly, I show you how to trade it. That's the key. How to trade it is not obvious, and it's not intuitive. It's not self-evident. It's very, very, very important that you learn how to trade the cycle indicator. So anyway, that's it, my friends. Rubberbandtrade.com. David typed it into the chat box there. Thank you, David. And that is hyperlinked, I see. So that's awesome sauce. And oh, when you get it, also you'll get my direct email address. So when you get that little course, you get my direct email address, and you can send me any questions you might have, and I'll be happy to answer them to the best of my ability. So you get support from it as well. I don't just give you the course and go hide. So I'm there to help you and be your trading coach also. All right, well, that's it. Thanks, everybody. I'm not going to drag it out. I guess I thought I had 15 minutes left. I guess I only had like 10, but thank you all very much for staying the extra time and for your patience with my technical difficulties.